Now, let's keep the conversation on the markets going on this Friday morning. We mentioned that the U.S. Fed Chair Jay Powell had investors back on the defensive yesterday, and certainly there have been some bearish voices raising red flags about the profit picture as well. But could there also be stock-picking opportunities despite headwinds? Well, let's ask Kathryn Rooney Vera, Chief Market Strategist at StoneX, and David Nelson, Chief Strategist at Bell Point Asset Management. Great to have both of you with us. And Kathryn, I know that you've had a pretty cautious view throughout 2023. How are you feeling at this point of the year?
This is a great conversation with David and you, John, because from my perspective, if, equity risk premium is pretty poor here in the U.S. as well as in Europe. The only place it's positive, in my view, is in Japan. But what could improve that? From the market's perspective, if the 10-year Treasury yield drops, that in theory should give a boost to equity markets. My take is different, John. I think that if the 10-year Treasury yield drops because we're entering into a recession or a contraction in consumption, then that's not good for equities, especially given where valuations are right now. I suspect that earnings growth of 12%, which is baked into the S&P 500 right now, 12% earnings growth for 2024 is unlikely to occur, given the likelihood of a lower nominal GDP growth here in the U.S. for next year. So I think that 10-year Treasury yields probably will come down, but I do expect that change, that correlation between treasuries and equity markets, which we saw occur last year where both went down, is going to go away for next year. So I'm more positive fixed income than equities for 2024, John.
That's what I was going to ask you. I mean, when it comes down to portfolio strategy, Kathryn, it's bonds all the way from your vantage point?
Well, they're certainly juicy at this point when you consider what the risk-free asset yields versus the earnings yield on the S&P 500 versus the high-yield bonds, what they yield. They're all pretty much in line. So I think it just makes sense to go with the risk-free asset, especially when it's yielding so juicy. And especially, I think, when recession is more likely than currently priced into the equity markets.
What are you watching the most right now? I mean, we just have a sea of information coming at us. What's the most important thing to watch in these final weeks of 2023?
Well, this is what makes markets, John. I am less positive with regard to tech, consumer discretionary, and communication services going into next year. I think we want to be more positioned in the less sexy sectors, but historically outperform in either stagflationary periods of time or recessionary periods of time. And those are utilities, staples, healthcare, insurance companies, energy. This is a late cycle investment strategy that I'm proposing, and I think that's the way to go. So what I'm looking for is a rollover in consumer confidence. At the end of the day, the U.S. is an economy based on consumption. Consumption has been resilient because of large-scale liquidity injections from the federal government and monetary authorities. Both are going away. That liquidity cushion in people's checking accounts has gone away. Student loan repayments is back on. Real wages are back to negative on a sequential basis. Real rates are positive. So I think that the consumer faces a lot of headwinds going into next year and is more likely than not going to roll over. That, I think, is going to be negative for corporations that are facing margin pressure, and very likely, I think, is going to result in layoffs going into next year, which will probably bring a contraction in consumption and recession here in the U.S.
Well, we'll have to watch that part closely.